Hi, welcome to my YouTube channel. I am Mary Sandra. Today we'll be talking about the Finance Act of 2021, taking cognizance of key notes as it affects different tax laws. Now, need me remind you once again that this bill was signed on the 31st of December 2021 with the effective date of what? 1st of January 2022, and it made about 40 amendments to various tax laws. So today we'll be looking at how the various changes and amendment that was made in the company income tax. So let's just jump right in. So with respect to insurance businesses and the calculation of minimum tax, remember, in the calculation of total tax payable for a company, you compute both the tax liability based on the total profit, then also when you finish calculating that total tax liability, you're also expected to calculate minimum tax, even if the question does not tell you, because in a situation whereby the minimum tax a company is supposed to pay is greater than the total tax liability, the company is expected to pay the minimum tax and other exemptions as the case may be. So it means that when calculating minimum tax for insurance businesses, you have to take note of what gross turnover shall imply. Now, insurance businesses are two. Basically, we have life insurance businesses abbreviated as LIBs and non-life insurance businesses abbreviated as non-LIBs. So the Act, according to Section 33, states that minimum tax shall not apply to insurance businesses for both non-life and life insurance business. For non-life, gross turnover shall mean gross premium and other income, while other income excluding frank investment income. It means that when noting what gross turnover implies for the sake of calculating minimum tax, the gross premium shall apply for life insurance businesses, but while calculating such for non-life insurance businesses, add both gross premium and other incomes. So that is just what he's trying to say. Then a copy of the actuary certificate for revaluation of unexpired risks or any other revaluation should be submitted to the Federal Inland Revenue Service (FRS) not more than 3 months after such revaluation. So they are expected to submit such documents 3 months, not more than 3 months after such revaluation has been carried out. So for other businesses, minimum tax rate was reduced from 0.5% to 0.25% for any 2 consecutive accounting period falling on 1st of January 2019 to 31st of December 2021, as may be elected by the taxpayer. So this practically explains itself. It means that minimum tax has been reduced to 0.25% for any 2 accounting periods falling between January 2019 and December 2021, and the taxpayer has the prerogative or can elect whichever one he or she chooses. So still in line with that, companies that claim the reduced minimum tax rule in section 33 of CETA but filed its tax return late will be liable to penalty equal to the benefit or reductions claimed. This basically explains. So if while you are claiming minimum tax rule according to section 33 of company income tax act, please file your return early. If not, you'll be liable to pay penalty equal to the benefit or reductions claim. So that's that for that. Then number 3, profits of companies engaged in educational activities are now liable to tax under Company Income Tax Act. So, and also the rate of tertiary education tax, also known as TET, has been increased to 2.5% of assessable profit. Just to state exactly how that section 23 subsection 1c of the act, how we stipulated it, it says that educational institutions are no longer exempted from income tax. Prior to this, such profit derived from educational companies were exempt from tax if such profits were derived from a trade or business carried on by such company. It means initially educational institutions are not supposed to pay company income tax except they delve into any other source of income which is not their core business, that's education. If they delve into other such businesses, such incomes from such businesses will be liable to tax. But now schools are to pay tax, educational institutions are to pay company income tax. Now the implication of this is that such profit from educational institutions are liable to company income tax at 20% or 30% depending on their turnover. Also, with respect to tertiary education tax, the tertiary education tax was not amended to reflect such treatment. However, tertiary education tax rule states that accessible profit for such tertiary education tax should be applicable is to be determined or reflective of such amount as computed as per Company Income Tax Act provisions. What is this saying? It means that in as much as tertiary education tax, when in the calculation of total tax liability, it includes company income tax at 30% or 20% as the case may be, plus education tax, that's tertiary education tax. The total is the total tax liability for a particular company. Now, tertiary education tax was not amended to incorporate this new change in CETA that says that educational institutions are to pay company income tax. However, tertiary education tax has already stated that when it comes to paying our tax, please go and check what CETA says. That is what you will pay. So if CETA is saying pay 2.5% of accessible profit, we are with them. So therefore, educational institutions are to pay 2.5% of the accessible profit as tertiary education tax. Finally, the Federal Inland Revenue Service stated that taxpayers may pay tax due in installments, provided that the final installment shall be paid on or before the due date of payment. So you have the freedom to spread your tax liability in as much as you pay everything on or before the due date of payment. So these are just a few changes with respect to company income tax. I would love to see your comments in the comment section below. I hope this video helps. Next, we'll be looking at capital gains tax, petroleum operations, as well as personal income tax. So next, we look at key changes in capital gains tax. So first is elimination of capital gains tax on exemption on the sale of shares. According to section 30, it states that capital gains tax at 10% shall now apply on gains from the disposal of shares where such proceeds are 100 million naira or above in any 12 consecutive months. It means that gains on the disposal of shares in which the proceeds are 100 million naira or above are now subjected to capital gains tax in as much as it occurred within a period of 12 months. So it explains itself. So before then, B basically explains itself. It says gains on the disposal of government securities are not subjected to capital gains tax. Exemptions to A, where capital gains tax shall not apply, is that 1. Proceed reinvested within the same tax year to acquire shares. This implies that if there is a sale of share, there's a disposal of share which is 100 million naira or above in a period of 12 consecutive months. However, such proceeds are reinvested in acquiring shares within that same tax year, capital gains tax shall not apply on such proceeds. Second exemption is that total disposal in any 12-month period is less than 100 million naira. If the disposal, it practically explains itself, because A states that such proceeds are subjected to capital gains tax shall be that which is 10 million naira or above. So if it is less, it is not subjected to capital gains tax. However, under this B, for such a person or a taxpayer to prove indeed that such disposal is less than 100 million naira in a period of 12 months, appropriate returns shall be provided to Federal Inland Revenue Service to that effect. So it is not just about stating it by word of mouth or showing it in your document that have been printed out. You must provide every return to prove indeed that the total disposal is less than 100 million naira, you provide that to the Federal Inland Revenue Service. Then finally, shares are transferred between a borrower and lender in a regulated securities lending transaction. So if such shares are transferred between two parties in a regulated setting, it is also exempted from capital gains tax. So pretty much those are the key changes to capital gains tax. Before we move on to petroleum operations as well as personal income tax, please share your comments in this comment section below. Thank you. Okay, so moving on to key changes that affects petroleum operations. So the act made several changes, which includes one, that the exemption of export profits was amended to exclude companies engaged in the upstream, midstream and downstream petroleum operation. This simply implies that for companies engaged in upstream, midstream and downstream operation, the profit from the export of goods are now liable to tax. Simple. That's what just the number A point is trying to state, that profits from the export of goods for companies engaged in upstream, midstream and downstream petroleum operations are now liable to tax. Secondly, companies involved in upstream petroleum operations are subjected to tax under Company Income Tax Act and not Petroleum Profit Tax Act. Just to reiterate, it says companies involved in such upstream petroleum operations previously subjected to tax under PPTA and Deep Offshore and Inland Basin Act are now taxable under CETA. So these companies are now liable to tax under the provisions of CETA and no longer under Petroleum Profit Tax Act. Next, given that the revenue generated from these activities are tied to the export of crude oil products, the Act amends the export exemption provision under CETA to exclude oil and gas companies engaged in these activities across the various value chains. So this is in line with the number 1 point, the A point and the B point. So across the value chain, these acts affect every one of them. Then finally, companies engaged in upstream petroleum operations would continue to withhold VAT even when they have not commenced operations or reached the 25 million naira turnover. So companies engaged in upstream petroleum operations can continue to withhold VAT, that's value added tax, even when they have not commenced operation or they have not reached their 25 million naira turnover. So these are just a few changes that affects petroleum operations in Nigeria. So next we'll be looking at company income tax and value and also capital gains tax. Thank you. Hi, welcome to my YouTube channel. I am Mary Sandra. Today we'll be looking at key notes as pertaining to the Finance Act of 2021. Now I need to state once again that this bill was signed on the 31st of December 2021 with effective date of 1st of January 2022, and the Finance Act of 2021 introduced over 40 amendments to existing tax laws. This video will be looking at personal income tax, the key changes that occurred in the Personal Income Tax Act. Now, the first thing is bank filings. As you see in A above, it says banks must submit the details of new customers quarterly, and a penalty for such failure is 1 million naira. The act also gives the power to a senior manager or a grade level 14 to request for information from persons for the purpose of obtaining full information regarding their income or gain. A default of any bank will be subject to a penalty of 1 million naira for each return or information not provided or incorrect information provided according to subsection 47 subsection 3. It means that if a bank does not submit details of new customers quarterly, or such details are incorrect, or such details does not provide all they should, they will be subjected to a fine of 1 million naira. Also, you can also see in section 49 subsection 2 that requires the bank must submit the names, not just the names. Details include both the names and addresses of all new customers. Now, the B part of it talks about insurance company. It says that only premiums paid by an individual for his or her life or for that of the spouse during the year preceding the year of assessment will be allowed as a deduction. Note, because premiums paid in respect of a contract for a deferred annuity on the life of a person or that of the spouse are not allowed as a tax deduction. That means they are not allowed. It means that this section is trying to say that for premiums, the only amount that will be permitted or that is permissible as an allowable deduction in respect of any year is that which was paid, is that premium which was paid by the individual for his or her life or for that of the spouse during the year preceding the year of assessment. It means any other premiums paid is no longer allowed as a deduction under Personal Income Tax Act. Now, another thing to note is fines for failure to comply with the provision of Personal Income Tax Act, as seen in section 94. See above talks about that penalty. It says failure to comply where no penalty was specifically provided is now 20,000 naira in the first instance and 2,000 naira per day for continuous default. So previously, it was what was obtainable was 5,000 naira in the first instance and 100 naira per day for continuous default. But this has been changed by the Finance Act of 2021 to 20,000 naira in the first instance and 2,000 naira per day for continuous default. Further default in the payment makes such taxpayer liable to 6 months imprisonment plus the liability owed. So it means it is no longer business as usual. Pay when you are supposed to pay, comply with the provisions of PITA, that is Personal Income Tax Act, to avoid both paying your liability owed and also imprisonment. So these are just few changes as relates to Personal Income Tax Act. We are going to look next as it pertains to company income tax and also capital gains tax.